Hi there, this is Anthony from Admin Inc., and I am sharing with you 7 business terms that are widely used in the business world today. The first is return on investment or rate of return. It's nothing but the revenue that you made in a certain period of time divided by the initial investment that you made. If the number is greater than 1, then you're doing good. If the number that is equal to 1 means you broke even or you have regained all the money that you have invested. If it's less than 1, then you have lost. The second would be ROE, which is the rate of exchange. And it's nothing but the dollars versus the currency that you're buying products from. So if you're buying products from France, they use euros, so you have to find how much you're selling your dollars for and buying euros for to be successful. Third would be revenue versus gross and net income. A lot of people misuse those words and they use them interchangeably. Now I'm going to clarify. Revenue is everything you have made. Let's say you sold a computer and you got $1,000. But that's not your income. The income is after cost. What's the cost for you to buy the computer? What's the cost for you to advertise to sell the computer? That is the number that you get, which is called gross income. Once you subtract your costs from the revenue, then you get gross income. And then you have to pay tax on that number. And the remainder is called, or the remaining number is called net income. That's your income. Now, the fourth term that we need to talk about is called dividends. Dividends is nothing but the income that you make from stocks. Basically, preferred stocks pay dividends. And the fifth term is depreciation, or it's also called capital consumption allowance. The law allows you to recoup your investment of different assets over a period of time, because those assets are going to live a certain period of time, after which the salvage value is going to be equal to 0. By salvage value, meaning the value after that term expires. So if you buy an Apple Watch for $400, you would assume that after the depreciation years, which is let's say 3 or 4 years, you will end up with 0 value for that watch. So if you allow yourself to divide that initial investment of the watch, which is $400, divided by 4 years, let's say, and you would allocate every month a cost for that called depreciation cost. This way, that number is not taxable. It will allow you to recoup that investment to be able to buy another watch after that term expires, which is 4 years. And after we talk about depreciation, we talk about hedging. Hedging is a financial concept that says you don't put all your eggs in one basket. So the smarter investor is a person who allocates his money into different sectors. For instance, if you are in real estate and you make all your money from real estate, but real estate is cyclical and after a period of time it goes down, so all your money, all your investments go down. Versus a guy who would segregate or who would invest in different places. Let's say 20% of your money in real estate, 20% of your money in stocks, 20% of your money in options, 20% of your money in index, and 20% of your money in mutual funds set aside for something else. That is a way that you can diversify your investments in a way that it's highly unlikely 2 sectors fail at the same time. And the last thing that I'm going to be talking about is opportunity cost. Opportunity cost is the cost of the opportunity had you have taken option B. For instance, you had $20,000 you had two options: either buy a car and use it for Uber and make $3,000 a month or $36,000 a year, or use that to invest in options. So if you invested in options and you lost that money, your opportunity cost would have been the money that you have made with Uber driving for a period of 1 year. Thank you so much for tuning in, and if you like the content, please smash the like button, and if you don't like it, please smash dislike. Thank you. Bye.